Why is traditional investing wisdom almost always wrong when you invest in unit trusts? Welcome back to my channel, the channel for personal finance and money matters. Remember to subscribe to my channel and turn on the notification bell if you'd like to watch more videos like this. Let's begin. Hi, my name is Louis, your financial educator. I've seen 95% of unit trust investors applying traditional investing wisdom to invest into unit trust portfolios, which turn out completely underwater. There are only 5% of the investors that succeed in unit trust investments to get to their financial goals. Are you wondering about what are the mistakes that 95% of the investors are making and what are the correct ways that 5% of the investors are applying? Continue watching. I've summarized 3 mistakes that 95% of investors are making and 3 correct ways that 5% of investors are applying. The 3 mistakes are buy low, sell high, buy in cheap funds, and trade funds. Mistake number 1. Buy low, sell high. Investors just love to buy low and sell high. No doubt, this is the correct way to gain money in the investment world. There's no real gain if you do not sell the asset. There's only paper gain. Here, I'm referring to buying low and selling high between the difference of 3 to 5% up and down in the unit trust portfolio. If you are going to invest in unit trust funds, then you need to remember that you're actually paying fees, upfront fee, management fee, trustee fee, etc. It is not worth buying and selling in that situation because the buy and sell fee is going to ruin your rate of return. Also, as you are paying management fees, the fund managers are in their duty to manage your funds for you, especially when it comes to buy low and sell high in the underlying assets of the funds. The key to invest into unit trust funds is to invest into the fund manager. Examine the fund manager's expertise. For example, if you want to invest into a Malaysia-focused fund, then look for the fund house or fund manager that is good at managing Malaysia funds. You'll be surprised to see not every Malaysia-focused funds perform the same way. Even if 2 Malaysia funds are investing in similar stocks, yet one may perform better than the other. Number 2, buy in cheap funds. This fund A is 20 cents. The other fund B is 1 ringgit and 20 cents. I want to invest into fund A, then I can get more units because it is cheaper. I've seen many investors react the exact same way when they are deciding which funds to invest. Do not make this mistake. Perhaps you can buy more units in Fund A, yet why don't you think about the reason Fund A being so cheap? Is it the Fund A not performing? Is it just the fund being launched at a cheaper price than the Fund B? Maybe Fund B has performed much better than Fund A. That is when you have to think twice when investing into unit trust funds purely based on the price of unit trust funds. Number 3, trade funds. This is the biggest mistake that most of the investors are doing. They are making very little profit to none. Sometimes they are even losing money by applying this technique to invest in funds. Why is trading not for unit trust funds? First, the cost structure. You pay a fee when you make every purchase into unit trust funds. Some unit trust funds even charge you for redemption charges. For example, you invested into a unit trust fund in hoping to earn 10% per annum return for 10 years. Your friend invested into a unit trust fund in hoping to time in and time out and eventually only earn a gross return of 10% per annum for 10 years. By comparing to your friend, you only paid one-time transaction fee. Maybe your advisor charged 2% front-end transaction fee. Your friend bought in and sold out 2 times a year, incurred a 4% front-end transaction fee every year. Eventually, you earn a net return of 9.8% per annum. However, your friend only earned a net return of 6% per annum. At the end of the day, who earned more? The answer is you. That might be a good scenario in the above example. What if your friend bought in and sold out 4 times a year? It means your friend paid an 8% front-end transaction fee every year. Eventually, he or she could only earn 2% net return per annum. These are the 3 correct ways that 5% of investors are doing. Number 1, buy when you like, sell when you need. Warren Buffett says, if you are not thinking about owning a stock for 10 years, then you don't even think about owning it for 10 minutes. In fact, the ideal holding period for Warren Buffett's investment is perpetual. That means forever. Warren Buffett does not buy into share investment by looking at the price for each share. He buys into share investment by looking to become the company's shareholder. The successful investors look into long-term perspective. They look into how much the investment will profit them in 5 years, 10 years or 20 years. They are looking at 50%, 100%, 200%, 500% and even more in the coming 5 years, 10 years or 20 years. So they invest anytime as they like because they understand the concept of time in the market is more important than timing the market. They will only sell the investment whenever they need the fund or the investment is no longer suitable for their investment appetite. Number 2, buy in value funds. They also buy in value funds instead of buying in cheaper funds. They understand the job of a fund manager. They know that they are entrusting their money to someone who is capable of managing their money. It is like you are paying someone who is capable of fixing the car for you when your car is broken. After all, no one is good at everything. Unless you are expert in investing and you can make 10% return per annum or 20% return per annum easily. Of course, you do not have to hire fund managers to manage funds for you. The other way around, maybe the fund manager should place the money for you to manage, or you become the fund manager to manage people's money. Thus, buy in value funds. Invest in the funds that you can see future value and future appreciation. Sometimes a cheap fund might simply mean that it is not performing well, and that is why the fund price is so cheap. You might need to question yourself again before investing into it. However, it is not always the case. Therefore, the man behind the unit trust fund is very important, the fund manager. Number 3, allocate funds. Also, the successful investors allocate funds, which means they invest into several funds to make it a portfolio that is well diversified. You do not want to put all your eggs in one basket, right? However, be aware of diversification. Sometimes you might over-diversify into too many funds and get an average return. Consult with a well-rounded unit trust consultant to create a portfolio that is diversified at your risk appetite and risk tolerance. Better yet, you should consult with the unit trust consultant that can be able to provide information about all funds in Malaysia. Then they won't be biased towards the company they are working with. Sometimes they might just recommend you their company's funds to invest because they are working for the company. Therefore, allocate your investment into a few funds from different fund houses to make it a portfolio. That's the 3 mistakes and 3 correct ways that investors are making. Like this video if you find it useful. Remember to subscribe to my channel as well. Thanks for watching. See you in the next video.